Have you ever wondered if it's possible to predict the next CPI report accurately? We've made it our mission to understand the intricacies of the economic reports so we may truly understand the inner workings of the economy and the trends within the financial markets. The Consumer Price Index, scheduled to be released shortly, will arm the Federal Reserve with valuable information as to when they should eventually cut interest rates. This begs the question: is it possible to predict the next CPI report? We've crunched some numbers and we're going to give you our best estimates. The CPI measures a change in the price of the basket of goods and services that represent the average consumer. It's comprised of several categories, including food and beverages, medical care, transportation. To estimate the change in prices for each category would require quite the lengthy study. So, for our purposes today, we're going to focus on the largest category: housing. Here we see the Fed funds futures, which predict the probability the Federal Reserve will leave interest rates unchanged at their June meeting. In red, there's currently a 41% chance interest rates will remain at the current levels by June. In blue, we see the daily percentage change. So in this case, the probabilities decline by 8% as the Fed futures react to the economic calendar. So what's the plan? We're going to review the past month's economic calendar since the release of the last CPI number, and we're going to make note of some of the most significant economic numbers which move the futures market. Those data sets which move the Fed futures market also give us a clue as to the state of the economy, which will ultimately be shown in our pending CPI report. Each report represents a piece to the puzzle. Based on this data, we're going to give you our best CPI prediction. We begin shortly after the release of the last CPI reports. The Federal Reserve met during their regularly scheduled meeting. As a result, the Fed meeting, the odds the rates will remain unchanged by June declined by 16% to a current 25%. Again, there was only a 25% chance the Fed would not cut rates by June. But what we're about to show you is how the news can really move the futures market. On March 21st, existing home sales were released. A positive report encourages the Fed not to cut rates, and this number was in fact good news. Existing home sales surge in a positive sign for the year's housing market. For the month of February, there were over 4.38 million existing homes sold, establishing a yearly high. Moreover, the median sales price of existing homes rose to 384,000, a 3-month high. Given the strength in the home sales, the Fed's appropriate move is to do nothing. On March 25th, we received our next significant economic report. Housing starts, a leading indicator showing the volume of new housing projects that have commenced. In reaction, the Fed futures June contract rose 6%. There's now a 30% probability the Fed will hold steady through June. In fact, we can see the housing starts appear to be trending higher for several months now, registering the second highest high since May of last year. The next major piece of news was reported on March 28th, and this was a big one. The GDP, gross domestic product, was released. As a result, the odds the Fed will leave rates unchanged in June surged 10% to a current level of 40%. The GDP revision was in fact quite strong. As we read the headline, U.S. economy continues to shine with help from consumers and the labor market. There was certainly the concern the GDP would decline rapidly from the prior quarter, but the GDP did not disappoint. The current rate of growth now stands at 3.4%. Moving forward to April 5th, the non-farm payrolls were released, boosting the odds in the futures June contract by 13% to a lofty 47%. At this point, there's nearly a 50% chance the Fed will not cut rates in June. The latest jobs numbers have certainly been a recipient of a great deal of press. We've learned 303,000 jobs were created in the past month, one of the best figures we've seen all year. So where do we stand at this point? Housing represents the largest component of the consumer price index. We've seen the housing data has been strong. From existing home sales, the median sales price, and the housing starts all look good. We've also seen strong GDP and employment numbers. But the best gauge is the market's reaction, and the Fed futures June contract predicting no reduction in interest rates through June have risen to 25 to 47%. So what's our prediction? Inflation is sticky. Given we see improvement not only in the housing data but also the GDP report, it's logical to conclude inflationary pressures have not subsided and may actually rise above our current 3.2% level. Also, it's worth mentioning we recently spoke about the jobs data. While on the surface the numbers look good, but after a little digging, there's good reason to doubt the strength in this segment of the economy. We've dissected the data and uncovered some pretty disturbing trends. Please feel free to click here if you'd like to learn more about the jobs report and what we uncovered.